Hello and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of The Tie. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Hello and welcome to Fundamental Value, a journey to quantify crypto. I'm your host, Joshua Frank, co-founder and CEO of The Tie. Today, I'm very excited to be joined by Mike Kraslow, head of U.S. venture capital at Mirae. Mike, it's great to have you on.
Great to be here. Thanks for having me, Josh.
So can you walk us through your background and how you, kind of discovered crypto? You come closer to the mic too.
Sure.
Yeah.
So I started my career in the public markets at BlackRock, and probably the most unsexy industry you can think of for a trading perspective, ETFs.
Yep.
Kind of learned from that seat about kind of two things, one about myself, one about the market. One is kind of asset allocation, which I think is important in anyone's portfolio, although many people on this listen to this podcast maybe YOLO all into crypto. The other thing I learned is I'm not a quant, and public markets were really not for me. So I ended up transitioning over to private equity, focusing on financial services. Spent a little bit of time in business school after that, tried to run at being an entrepreneur like yourself, although unfortunately I didn't have the stomach that you have to kind of make something from start to finish, and realized I'm much better at kind of hopping from project to project and ending up venture finding the right fit where I can work with our portfolio companies to help them through like their toughest problems without having to spend all my time solving one problem. After business school, I ended up at Amex on their venture team and was fortunate enough in the very beginning of the pandemic to come across Falcon X. And that, I give them a lot of credit because crypto was always something that I wanted to spend time on, but didn't have the time to. And one of the great parts of my job is I get to dig very deeply into new technologies and new businesses and understand things from the ground up. And that really got me really bullish on the sector for a couple of reasons. One, in the basic laws of supply and demand, I saw the demand that was coming from the institutional side, and I realized that the infrastructure wasn't there to allow that to happen. So just from a basic supply and demand perspective, I saw what was coming in the future. And then the second piece was really, after doing some research, I realized that while there's still probably some of the conversation we're having today around security of digital assets, I realized that the higher the value of underlying digital asset, actually more secure it became because of the way that things were structured. So it gave me confidence to kind of dig deeper and kind of go all in from there. After Amex, I ended up Mirae, and my second week on the job, ended up following the Buffett rule of advice, invest in what you know, and invest in Falcon X again, and kind of turned the whole organization onto crypto.
And so can you tell us a little bit about Mirae broadly? So, I think it's a relatively well-known firm, but I think it is a much bigger firm than I think a lot of people give it credit for. So kind of talk about Mirae, kind of the broad global mandate of what the firm does, and how, what does your role specifically mean in context of the entire firm?
Of course. So Mirae is a very large institutional asset manager. At this point, sitting with roughly 700 billion AUM. Now, I may be off a little bit considering the market turmoil, but overall, extremely large. We have a bunch of different strategies. Most of that is in the public markets, a large private market book as well. Own a lot of ETF businesses, a company called Global X, which is one of the most prominent ETF issuers out there, as well as real estate portfolio, insurance business, brokerage, you name it. Of that, roughly $4.5 billion has been invested into venture and growth. You call later stage venture growth at Mirae. And the venture team is split up into three regions: one team in Asia, another one in India, and then I lead our team here in the US. And we basically cover all regions outside of India and Asia.
And so where is the majority? So you mentioned 700 billion in AUM. Where is the majority of that AUM in the ETF business, and where are the largest investors? Like, I know Mirae is based in Korea. Is it primarily like Korean pensions and endowments and stuff that are in Mirae, or is it a pretty broad mix of?
So we have a very broad LP pool. I say one of the interesting things about Mirae is that we are a truly global firm. We have 16 offices. We have offices in 16 different countries across the globe, and very tight relationships where we have boots on the ground. So one of the true differentiators between Mirae and many other investors is that we are a truly global platform. I can get to it a little bit later about what we look for, but one of the things we do look for are businesses that are either currently or looking to be in multiple markets. Those 16 different regions that we're in, or countries that we're in, really give us a competitive advantage as far as helping companies enter new markets. It's one of the things that's from an institutional standpoint that I think that we can really help companies with going forward.
And so you mentioned having three separate, venture bases that you're kind of investing out of. Do you guys ever come together and do a deal together? Like, let's say, you want to lead a Series C and it's a $200 million check. You guys can only write 100 out of the US. Will you ever syndicate that out to the rest of Mirae? Or
so we tend to operate together. So It's a lot of sharing of deal flow and around coverage.
Is it the same capital pool though, or is it separate?
So we do have separate capital pools, but we tend to operate as one. So from a portfolio company perspective, it should be no different. From our perspective, I think the way that's structured makes it pretty unique in that economically it can make sense to write, a 7-figure check or a 9-figure check, which is great because you hear of a bunch of other large funds where I have a minimum of 25 million, I have a minimum of ownership percentage. We don't really focus on that. We instead focus on backing the best entrepreneurs, the best categories.
And so when you're investing in businesses, so it sounds like you're pretty stage agnostic as well. Is that all out of the same vehicle? So you're investing out of one vehicle into seed, Series A, Series B type deals? Is my first question. My second question is, what are the types of things that you're looking for, in not in terms of the types of assets, we'll get into that in a second, but more like, do you look for board seats? Do you look for a certain amount of control, or are you very flexible in that regard?
So we're extremely flexible. I don't think it makes sense to think about it from a vehicle perspective. Instead, it makes to think of your point of contact. So if you're based in Asia, one of my colleagues in Asia would most likely be your point of contact. In India, one of my colleagues in India would most likely be your point of contact. Outside of that, me or someone directly in my team most likely be your point of contact. And then as far as, writing the check goes, like anything else, it's based on conviction, right? So the higher conviction we have, the bigger the check that we can write. Also, it's obviously stage dependent, right? It doesn't make sense to write a $100 million check into a seed round, although we've seen some of those in the last year and a half.
Only crypto.
Yeah, only in crypto. AI, maybe too. But when we're looking for companies, we look for two things. One, a category leader, however we can define that category. And two is that international piece that we mentioned, because again, where we can add the most value from an institutional standpoint is really helping these companies enter new markets. And
so how do you actually go about that support for portcos? So, curious as to what support and actually I think basically to take a step back, how important how value add do you think your investor should be? Like, do you think, obviously a lot of VCs say, hey, you can use our hiring network, or you can use this service or that service, or we have, a group of experts that can help you with go-to-market strategy or this or that. What role do you think a VC plays in the success of a company, and does it depend on the stage? And how do you actually go about supporting your portfolio companies? How does it actually physically work?
So there's a couple of things in that question. I'll unpack the support first. And I think it really depends on your investment strategy. So stage and how you think that you're adding value to your companies are really important. Where we like to add value are obviously our personal networks, right? So you get me or whoever else you're working with directly in all of our networks. Secondly, you get the Mirae brand, right? Where especially in certain parts of the world, like it really means something to have Mirae. Many people listening to this may be on the Western world where they haven't heard of Mirae that much, and it's not the same. But if you're going to Asia and Mirae Invest, it really it's a brand builder from that perspective. And then lastly, there's certain insights that you can get from looking at a broad swath of companies, and B, operating in multiple different markets. And it's really kind of stitching those things together that is my job. And it's not my job to tell someone how to run their business or tell someone how to hire, how to fire, right? But you can start to see some things in a way that founders can't, because you're so laser focused on building your product, getting your customers, shipping out what you need to on your list, that you may not see some of the broader things that are happening in the market. Like one example I can give you is, obviously, this is a crypto focused podcast, and I've spent a lot of time in the space, but it's not the only thing that we do. And after the Luna collapse, it's kind of when, say, crypto winter started. But there started to be some kind of shakiness in the overall economic landscape prior to that we saw because we were looking at companies that weren't just crypto companies. So being able to give a little bit more of a heads up to our portfolio companies, is something that, is value add from looking at not just, one sector.
And so can you, well, I guess one question before we even get into that is, what do you guys think of in terms of the secondary market right now? Actually, right now there are a lot of venture firms that are more distressed that are looking for liquidity and particular, venture bets that they've made. Do you guys look, or can you, within your mandate, invest in secondaries and companies? How excited are you about that opportunity, and how do you view kind of distressed opportunities? Is that something that you guys are more excited about, or are you more looking at high growth companies?
So our strategy is tended to gear towards more of the high growth companies. Yep. Now, we wouldn't be doing our job if we limited what we could and could not invest into only primary versus secondary. However, at the stage that we typically invest at, it gives way more comfort to have primary shares than secondary shares, considering that,
it's also probably the information that you're getting that you need to like because you guys do Series D and E, right? So you probably need to have quite a bit of financial information to build conviction in that decision. And I presume with secondaries, you probably would have naturally less.
So we would go earlier than that. I think in some cases we would get that information from the companies as well.
Yep.
But in today's environment, we, I think we'd really question why someone's taking money off the table in this environment versus others. And
what if it's like secondaries of another VC fund that's having liquidity issues, as an example, or like a prop trading firm or something?
Listen, again, everything's on the table,
right?
But I think right now the bid-ask spread between secondary sellers and buyers is still pretty large, even for top names. So it's something you have to consider, right? Everything has the right price, right? I wouldn't be doing my job if I just said no off the top.
Right.
That being said, the way that we like to work with companies and the involvement we like to have with them, we prefer to have it be primary. We prefer to have it go through the investor, the operator and the investor.
Yep.
That being said, right, there are some companies that we've been tracking for a long period of time that the right price would be great.
And so can you talk us through kind of the Mirae venture strategy within the US broadly? Are you looking for, what are the different sectors that you're investing in? It sounds like you're relatively sector agnostic, but are there certain areas of focus for you? And what sectors, and can be non-crypto, are you most excited about?
Yeah, so I think this is another point that's really worth mentioning. Even though we are sector agnostic, I think we're not doing our job and we're not able to pick the right companies and not being able to help the companies appropriately if we don't understand the sector well enough. So obviously we went very deep into Web3 and crypto and made several investments there, but also some areas we're looking at now are around climate tech, AI, and sustainability are probably some other major pillars that we're looking at right now.
What sector have you seen be least impacted by kind of this global, macro conditions, right? Is there a sector right now, maybe it's climate tech or something else, that's actually really hot, that's trading at kind of crazy multiples, or have we seen kind of a compression across the board?
So you're always going to see crazy multiples for companies that are able to aggregate the right amount of hype around them. I say right now, obviously with all the stuff happening around generative AI, that's one where you're starting to see some things where the multiples may still be a little bit crazy. I think when you think about how to invest, you have to think about two things: your entry point and your exit point. A lot of investors are not necessarily thinking about the exit. And when you think about the multiple, right, the multiple you pay is fine no matter what it is, if that company can grow well past that valuation into the next round. And part of what, the bubble, I think it's fair to say a bubble at this point, highlighted is that people were taking money because it was available to them, and they were raising multiple times within a year without actually showing that much traction, that change in traction. And some entrepreneurs were thinking that, okay, well, I raised at a 50x multiple last time, I doubled, I deserve another 50x multiple. That's not exactly how it works. Like a 50x multiple is fine if the true trading value is 10x and you're growing more than 5x the next year. Right. So it's all growth adjusted. And in our world, growth is still really important, even though there's been a shift to thinking about, profitability and unit economics. The same thing can be said if you're just growing, 20% a year and you're doing it profitably, right? That's a private equity deal, right? And you're not getting anywhere near the same multiples you were getting before, and maybe even valued off of EBITDA, which likely will be a lot smaller than your revenue number. So you have to think about what
You're
type
the
of business
first
you really
VC
are.
I've ever talked about that mentions the word EBITDA. That's usually
I did spend time in private equity, so
yeah. I know. EBITDA is a very important word. It's there's so many companies that I look at and I'm like, you guys raised at 40 or 50x, right? And you're burning, double what your revenue is every single year at a late stage company. And it's like, how does that possibly make sense? Like in what world, right? I mean, I think even BlockFi before they blew up was just throwing cash into an incinerator basically. And I think there's a lot of other firms like that. And I don't understand this growth at all cost mentality, but it sounds like that's obviously switching.
So growth at all costs makes sense if you understand the unit economics and unit economics work.
Right.
If I can put in $1 and get $2 back,
yeah,
I want to put in as many dollars as I possibly can to get $2 back.
Doesn't necessarily work for companies like Getter and all those grocery on demand businesses that were like, I think one of them, I forgot which one it was losing like $70 an order on average to grow.
So again, don't want to put point figures at certain business models, but some things require scale in order to hit unit economic positivity. Other opportunities also are dependent on the cost of capital, right? So one thing that's probably not talked about enough is if I can get 4% by putting my money in a 3-month CD, right? Not necessarily my capital specifically, because I already have dedicated funds to my venture fund, but like any investor would have to say,
LP,
does it make sense to put money into this, very risky bet that most likely will net me, 15, 20% if it works, right? Like that's not exactly a great, risk-adjusted return in today's environment.
What are you seeing in terms of lick preferences then, in terms of like risk-adjusted return? Are you seeing, I presume most deals that you're doing, and for anyone who doesn't know, a liquidation preference means as an investor, you get your money out first, right? So if you invest $20 million at a $200 million valuation, your $20 million is off the table first. What are you seeing in terms of liquidation preferences? Has there been any switch? Are you seeing firms that kind of need the cash more coming to the table with higher lick preferences, or we haven't really seen that in market yet?
So I think there's two things you have to think about when applying a liquidity preference. One is like, will there be anything left at the end, right? And, I think where you're seeing it the most are funds supporting their existing portfolio companies that they think are real businesses. Maybe gone ahead of themselves, maybe aren't worth what they were the last round of financing. And you don't necessarily want to have a down round because that can lead to a death spiral where, you start to lower the value of the company. That obviously has huge negative effects on the employee base. Then they leave. Then the value of the company continues to go down, and no one wants that. So the liquidity preferences are, I think, best used, at least right now, on companies that are in your portfolio that may need the cash to achieve milestones that they thought they'd be able to achieve previously in a different environment, and still gives you an opportunity to not only protect your existing investment, but give the company the capital it needs to, have some form of soft landing.
And so let's kind of pivot to crypto. So you've made 4 investments so far out of Mirae in the digital asset space. Can you kind of walk us through the different investments that you've made and why you were particularly excited about each of the opportunities? Obviously, you've already talked about Falcon X, so maybe the other 3 investments.
Sure. So when I first started, Mirae had not made any investments in crypto. And it was one of the things that I was most bullish on when I started. And to give you guys context, I started in early 2021. So I think the whole world was pretty bullish on crypto at that point. And the way I was thinking about it was, we are a large financial institution. What can I get these other colleagues of mine that may be not necessarily venture investors to understand, right? And I started with businesses that I thought at one point Mirae would be a customer of. So Falcon X is a digital asset prime brokerage. Clearly makes tons of sense on, as we start to put out crypto products, down the road. The second was Figment, which is, a validator for proof of stake. And if you believe proof of stake is going to play a huge role here, it doesn't really matter what the underlying tokens are today, but if it's going to exist in the long run, it became pretty clear to me that the way that proof of stake worked, there couldn't just be one winner. There had to be a couple winners. And I mentioned before, category winner, category leader is very important to us. So it became pretty clear to me that Figment was going to be one of the 2 or 3 winners in the space. And I had strong conviction that proof of stake was going to exist for a long period of time. So that was the second. Then we moved to start to spend more time around the metaverse and gaming. Now, metaverse has died down a little bit, but we initially looked at the sandbox, and then from that became aware of Animoca Brands and decided that it was a much better risk-adjusted investment for us to have broad exposure through Animoca. Also could be a good co-investment partner for us down the road since they do make a lot of investments themselves. And then the last one we made an investment in is Immutable X, which covered a couple things that were pretty important at the time. One is infrastructure around NFTs, specifically for gaming. They incorporate the ZK rollup technology, which was obviously very big in layer twos. And this was during kind of the Ethereum gas craze. So understanding that was really important. And the idea behind Immutable was kind of twofold. One, blockchain-based gaming, we had strong and still do have strong conviction on where it ends up in the long run. And Immutable was 100% focused on that compared to some of their competitors, namely Solana or Polygon, and had pretty strong belief from my time, even just operating my own business on a very small scale, that if you focus on too many things at once, you're really focusing on nothing. So the company that is most focused on the sector will win. I strongly believe that's playing out right now. And the second piece was what Immutable is really doing is facilitating a distributed order book. So if you think about when you go to an exchange or anywhere you go, you're focused on liquidity, right? So if I'm going to sell you the spear, right, I want to go where I can get the best value for the spear. Now, the way things have been operating for most of these early blockchain-based games is they create a digital asset, then you have to take the eyeball off of the game or the ecosystem and send it over to OpenSea or Magic Eden, and that's where you're going to get your liquidity. What Immutable allows you to do is keep that eyeball in the ecosystem, but still pull liquidity from those other areas. So I didn't necessarily believe that an OpenSea or Magic Eden is going to be where everyone automatically goes to trade. Maybe they will trade if they're doing speculation or if they're trying to sell a broad array of assets across multiple ecosystems. But if you want to be someone who's just playing the game and you want to be able to accrue value from your asset or exchange it for something else, those entities will eventually want to keep you in the ecosystem. So if you think like long tail, like the best way to break any type of thesis is to think, in the best case or worst case scenario. So in the best case scenario, Disney's creating a Marvel game. They have NFT of Iron Man. They're not going to let you go to OpenSea in order to trade that NFT of Iron Man. They're going to want you to stay in the Disney ecosystem. So how can you do that while also pulling liquidity from these other larger ecosystems? And that is what Immutable's solving.
So one of the investments that you mentioned, Figment, staking provider, one of the things that I've always kind of, I wouldn't say struggled with staking providers, but a concern I've always had is how do you hedge your risk, right? I guess that's the problem with any sort of, I wouldn't say that they're transactional because they're different, but if you're a staking, and I'm not suggesting that Figment was a big Solana staking provider, right? But Solana is now trading at a 90+% discount from its all-time high, right? And so naturally, as a staking provider, you're receiving a portion of, basically fees accrued or revenue generated from staking. And so how does it, to me, a staking provider is kind of like investing in an ETF in a way, right? Obviously or maybe an ETF issuer, but with very highly volatile tokens kind of underneath it. And so how do these businesses actually go about hedging risk? Because I've always been concerned that a staking provider in a down market can get absolutely destroyed in terms of the revenue that they're generating.
So I think it's twofold, right? So one is, can you actually hedge the underlying token? You can in some ways, right? But ultimately, your success is somewhat dependent on the ecosystem. I think what's important for someone like Figment is that they're not dependent on one token.
Yep.
Right. It's across ecosystem. If you believe in the technology, right, they build a reputation where they're the first one you go to,
right,
or one of the first ones you go to, and that's really where you can hedge for the long term. I think we'll get to talk more about tokens later, but when you think about what happened in 2001 versus now, obviously the asset has depreciated a lot, right, or come back down to earth, however you want to describe it. And I think it's important to understand that my role as a VC is not to be a market timer. Right. It's to think about long-term trends that are here to stay.
Right.
So all I care for Figment is I never expected it to be a straight line up, but I care that they're continuing to take market share. They continue to increase brand awareness.
If crypto succeeds and if they manage their risk well in terms of having runway and things like that, you have the belief that they're the best in class company. And so therefore, in the long run, it ends up being a winner.
that's kind of how we think about it. Obviously, we can be helpful in other aspects. We can provide different tools and networks within our own portfolio to help them out and do some of the hedging if they decide to do so, or give them a heads up on things that we're seeing so they can get in front of certain scenarios. But at the end of the day, right, it's not my job to tell someone how to run their business. It's to point out risks and allow them to kind of hedge and manage. So what I'm really thinking about is, okay, are you managing your cash position properly? Are you managing, your hiring, properly? Are you allocating resources where you need to? Or do you need help getting in front of any large contracts that I have or my colleagues have relationships with? Like it's pretty basic, from that standpoint. And, some people will say, okay, well, then VC is not really doing much. But like, again, seeing things across the spectrum and being able to give a heads up and not focus on only kind of the minutia of executing your broader vision. Sometimes, looking at things from the 10,000 foot view versus, on the ground will give insights that hopefully in the right situation are absorbed and digested properly by the operators to take advantage of.
And so one of the other deals that you mentioned is Immutable X, which actually has a token. And so obviously the three other deals you've done are equity. So presumably it's the only token deal that Mirae has done. And so one of the questions that I've always had is like, how do you think about diligencing an equity versus a token deal, right? Like what difference is there? And how do you get comfortable underwriting a token from a valuation perspective? Because obviously you underwrite an X company, Y company, right? Like you underwrite Figment. Presumably there's sub-public comp that you can look at for some tangentially relevant business. And you go like, look, I think in maturity, this company trades at 8x EBITDA, right? And so therefore, I think they're going to continue to grow at this rate. I think this is the TAM and I can underwrite it. But from a token perspective, like obviously the market is incredibly immature, right? Theoretically, if you started in 21, right, in November 21, there were some tokens that were trading at 20x higher, 20x higher market caps. I wouldn't say valuations. I think that's a generous word. So how do you kind of get comfortable underwriting a token?
So let's be clear. I think Mirae is a bit of a oxymoron and talking out of two sides of my mouth, but Mirae is conservative for a VC, right? Yep. So we are part of a large organization. Like again, the brand matters not just here in the US, but overseas.
Yep.
And we actually did not underwrite any token deals. Our investment in Immutable is only on the equity side. So when we think about it, like it was kind of discounted working capital in that scenario.
So the token was like, okay, this is an extra.
Token was already issued.
Right.
So it wasn't, something that we were really focused on for,
presumably that was looped in some capacity into whatever the deal was.
Think about it as part of their balance sheet and it's, working capital to help them go out and acquire more games to build on their platform. Right.
So, I guess the question in light of the FTX, debacle becomes just because you have an asset on your balance sheet that you're putting at some valuation and some theoretical market cap is 100 million in Immutable X tokens really worth 100 million in Immutable? I'm not saying Immutable X as specifically. I'm saying
I'll be very honest with you. So all the companies have some form of token balance.
Yep.
That we invested in. But it was heavily discounted, at the time that we made the investment. We stayed away from the, invest in a company's equity for a token warrant and try to cash out.
Yep.
That was something where, at the time, I wish we could move fast enough because I think it was an easy way to print money. But I think in retrospect, we were right in understanding that it doesn't really make too much sense as a long-term viable option. And like I said, I'm not trying to time the market. I'm trying to make sure that I invest in sustainable business models. So a lot of this, at some point, it was more profitable for you to think about a cool technology, write the line of code, ICO or issue a token, and the market will reward you more for that than for actually the historical way of doing something is you build technology, you keep it in-house, you build a business model around that technology that is your competitive advantage, and you go out and you start to earn money off of the services that you're providing. So what gave us comfort is that Immutable is building something, they're providing a service, they're earning value, and that revenue accrues, in this case, a portion to the token and a portion to the equity, and we're able to underwrite the equity. So we didn't really have to focus on the token too much, other than to think about it as kind of discounted working capital that's available to them today. But even without it, they have many years of runway to achieve their goals. So it's one of those situations where if it went to zero tomorrow, obviously wouldn't be great, but I don't think it materially changes the long-term outcome of what we would see for the business.
So presumably you've seen a large number of crypto businesses. Obviously, you've invested in 4, which I presume you've seen at least 40 or 50, right? Over the if not significantly more. And so what I'm curious as to, look, I don't know how many balance sheets you saw. I'm sure you saw a lot. How heavy were most of the companies that you saw in terms of their crypto holdings on balance sheet? Like, do you think the drawdowns in tokens had a material impact on the balance sheet of stage agnostic of a huge number of companies in this space?
So it definitely had a large impact. I mean, there's a couple of things that I've heard that I think have larger impacts, such as where you kept your money. I'm not sure if it's like a shocker or if I'm even really supposed to be talking about it on the podcast, but I've heard that, call it a very large company that is no longer with us, was leading around and then forcing those companies to keep all the reserves with them.
Oh, I mean, everyone knows that FTX was forcing people to keep their reserves.
So like stuff like that.
This podcast is supposed to be candid. You're supposed to talk shit about crypto.
And I never want to talk shit about anybody, at least unless it's to their face, then they can refute it. But I think that has a bigger impact. I think the bigger impact is around trust and whether or not some of these businesses should exist that's based off of trading or token volume. I think what we've seen a lot of, and it kind of highlighted kind of super impressive growth in 21, and now some of the issues are the involvement of the token on the business model, right? So I think that has a bigger impact than the balance sheet, because balance sheets can grow and decrease. You can always raise more money if your business is still viable and earning money. But if your entire revenue is based off the token and you do hit the point where you do need more capital, then not only are you facing multiple contraction, but revenue contraction. And then the value of your business is significantly lower than what you raised before, to the point where if you ever were to need more capital, right, it would be a severe down round that just the headlines alone would probably kill your business.
Well, I think there's also a number of businesses that had contracts that paid them in tokens, right? And so, let's say they thought they were 5 million ARR, right? But they had some sort of lock on the token as part of the deal. Maybe they're 1 million ARR now just because the value of the tokens have depreciated so much.
So listen, that's obviously a problem, but it's a fixable problem,
right?
Long run. I think the bigger issue is if all your revenues in tokens, right? The ones that kind of struck me as, red flags were companies that would pay themselves in revenue of their own tokens, where they were so dependent on the ecosystem that it became very apparent to me that if you can't figure out an intrinsic value of this particular token, you can't find intrinsic value for the company, right? Going back to Figment, if I believe in proof of stake, proof of stake is going to exist, and there's going to be some form of revenue that they're going to be able to gather as long as this continues to be a tool that has an upward trajectory that we can believe regardless of the underlying token prices today or in 2021. But,
and I think to your point on Figment, right? Presumably what's happening now has no significant impact on somebody's desirability to stake, in that staking is non-custodial, right? So, whereas if you were viewing an exchange's assets under custody as some sort of revenue driver, that might be very different than looking at assets under stake, because staking is non-custodial.
Yeah, so I think there's two things there. One is talking about custodial versus non-custodial, which I don't necessarily have a huge opinion on right now, but I think it's more important of who your customer is. So one of the things that we stayed away from was a lot of the consumer-facing businesses, and that was mainly because one of the things that I think probably is talked about a lot, but maybe not fully understand, is the role of the regulators in all this long term. And it was our strong belief from the insights that we were able to gather that if your customers are big boys and girls that are institutions, the regulators are not going to come after you. But if they are consumers and something like the FTX fiasco happens or Luna happens, the consumer that lost all their money, right, is going to be, what the hell happened? Why didn't anyone protect me from this? Because no one really wants to take responsibility for losing all their own money. And that's where the regulators are going to come in, right? Honestly, it correlates a lot also to kind of some of the neobanks and kind of general fintechs that are operating on the peripheral of licenses or doing some things that normally you would require pretty heavily financial licenses to operate, that were not actually regulated at all. And, obviously it's very easy to make money in a bull market where everything's going up. And, the concept of like a Ponzi scheme, whether or not we want to talk about it or not, like it works if assets keep going up or you keep on getting more people to give you assets. But once that stops, then the cracks in the foundation become gaping holes and companies go out of business.
So actually, speaking of consumer plays, I remember in 2018 vividly, and I'm not going to say who it is, speaking to a consumer fintech in crypto, which grew very large and no longer exists. And I spoke to the CEO and founder of the company, and he's like, growth at all costs, and then ask regulators for forgiveness later. And I was like, that doesn't seem like a great strategy. They got sued and faced stiff fines from regulators, in addition to later going out of business. But I think that's a fair and valid point. I think, look, right now you look like a genius not being in consumer. Consumers gotten destroyed across the board, right? Like
I don't know if you call me a genius, right? I think it's also you invest.
Well, I mean, but like most people had some consumer exposure, so I think broadly speaking, not being in consumer is probably a good decision. And I think consumer is also an area that got so much competition, right? There's 100 Robinhood competitors, right? Like there's 100 competitors to, SoFi Invest, right? Like, there's just a million of these different, like, small to mid-size, trading platforms, whether they be for Voyager, right? And obviously that doesn't exist anymore, but like, things that kind of operate in that arena. So I think that makes sense. So my next question is, all right, with everything that's happened in crypto, how do you go about underwriting growth rounds in the space right now? How do you actually think about that in terms of like, has the TAM, you're investing for the long run, do you think the TAM on crypto has significantly changed over the last few months in the long run? Obviously, how like is the fund a 7-year or 10-year fund? What is it?
10-year fund.
10-year fund, right? So in a 10-year fund perspective, right? Presumably you have like 8 years left or 9 years, whatever it is, right? Do you think the long-term total addressable market for digital assets has changed? And how do you actually think about underwriting growth in terms of like multiples in public markets have compressed? Like what kind of difference is there now? And are you more excited about earlier stage versus later stage deals at this point?
So this is a bit of a macro question, right?
Yep.
So let's attack the multiples first, because I think that's the
and it doesn't need to be a crypto specific question.
I think that's the easiest way to start, right? So if you think about multiples, right? Multiples were priced on growth,
yep,
right? And they were priced on growth because kind of what I alluded to before, like interest rates were zero, investors had to get cash out the door. You had to search for growth and yield somewhere. So it was very cheap for you to put money in today that's earning zero yield and hope for some return in the future, right? You didn't have to discount those cash flows with anything. So the value of future cash flows were worth more. So if you're thinking about how you're going to value a company now, the multiple has to contract because there is a better alternative for short-term returns. And therefore, the cost of capital has increased. And if you can't at least show an opportunity to get that cash back quicker, then your multiple is going to be much lower than before. If you look at crypto in general, right, I think the overall large-scale TAM is still enormous, but the short-term TAM is obviously shrunken significantly, and that impacts what you can pay per business because you don't know how far out into the future their actions start to return cash in a meaningful way. So that's kind of how you have to think about it from a baseline perspective. The other thing, which we talk about sometimes, and I don't necessarily think is a real outcome, but something you have to be aware of, like what's the market cap of all crypto right now?
$1 billion or something?
What, 800 billion or something like that, right? And that's mostly ETH and Bitcoin, but like still like 800, like that's something that could theoretically be taken down. Now, for someone who spends a lot of time in the space, you understand who's all the people that are building there and all the infrastructure that's already existing. So, I have pretty high conviction that that's not going to happen. That being said, like at what point can someone take out any of these main protocols? Like what if someone figures out a hack for, to take out Bitcoin? Like, it's been pretty tested over the last, 10, 12 years, right? So it's not likely, but I mean, I haven't heard exactly who.
But does that impact multiples on a particular company, or does that impact your comfort level in the percentage allocation of the fund to digital assets?
I think it probably is the latter.
Okay.
And I think the long-term growth, like the way that we think about digital assets, is not tied to what exists today. It's more of the digitization of existing assets and a lot of the rails and infrastructure.
Is that a newer pivot though towards more like the tokenization of securities, or that's kind of been broadly thought process you've had?
So I think it's probably more kind of accepted as an idea now, but that was in my underwriting case for Falcon X.
Right.
So it was the first thing I did was, okay, great. Am I going to try to convince some, C-level executives in Korea that Falcon X is going to be huge because Bitcoin and ETH are going to be huge, or some other tokens going to be huge, or convinced that, they have the infrastructure to handle whenever, CBDCs are more prevalent or whatever, other digital assets, other things are digitized, including existing infrastructure. The first thing that I did when I first looked at Falcon X at Amex was I looked at the size of the market cap, which at that point was $250–300 billion, and compared that to the size of the total equity market cap globally, which is like 94 trillion or something like that, or 74 trillion. I forget the exact number. But then you start to see, like, if you believe this is a transition as an infrastructure, like blockchain as infrastructure to transition, then you don't have to worry about a token. You don't have to worry about Bitcoin or just ETH. You just have to believe that our financial infrastructure is going to transition to this newer, better form of infrastructure, which right now we're calling crypto, right? And if you believe that, then a lot of the players that exist today will have a place in the future.
And so thinking about crypto specifically, right now, let's say the overall token market cap is 800. I don't know what the exact number is. I think you're in the ballpark. Overall value of assets in the world are tens, if not hundreds of trillions of dollars. What do you think the opportunity for digital assets is from an allocator perspective, right? Let's not take the digitization of securities and more traditional assets, but actually crypto. Like, do you think in 10 years from now, crypto becomes a 2% allocation for the biggest pensions and endowments of the world, or does it become a 10% allocation? Like, how big do you think this opportunity becomes?
I think it depends on the intrinsic value of the underlying asset.
Right.
So
do you think any assets have an underlying intrinsic value right now within crypto?
I do. I think the easiest one to point to is ETH, right? There's people building on it. And if you believe, kind of the ETH 2.0 structure, right? It's kind of structured like a share buyback where you can accrue value in that structure. Long run though, like my belief is probably most of these are securities that operate like a security.
But is that a bad thing?
Why would that be a bad thing?
I don't know. It's a bad thing for some crypto companies, but
it's a bad thing for anyone who's like, I hate regulation, right? But like,
or that like issued a token and is now going to get fined by.
Well, listen, there's governance tokens. There's, it's just, how do you value just governance, right? Obviously, someone smarter than I can go out and value these things. You look at the different types of shares in the public markets and whether or not they actually have real governance rights or like there's super governance rights for founders. Whether or not
I think governance is a good question though, because like so many tokens that I'm friends with the founders of, they control the vote. Like just because you have governance, that like it's like, okay, let me go call up my two largest investors. And I think governance is kind of a facade for trying to avoid securities regulation.
Maybe. I don't think most of the tokens have any real value, if that's where we're getting at. Most of the tokens today. But I think the concept of tokenizing an asset is really powerful. And again, we spend most of our time focused on infrastructure providers.
Right.
And we think that infrastructure is going to be around to help support as kind of there's a more underwritable use case for some of these tokens.
And so that's an interesting point. And so what specifically about tokenization of assets? Is it the fact that it's like infinitely divisible, it's easily transmittable? Like why should a particular, like let's say a REIT, why should a REIT be tokenized or an equity or this or that? Like what is the actual, what about tokenization has you excited?
Well, think about some of the basic companies that came around just in fintech prior to kind of this most recent crypto boom. Like you have like Acorns, which allowed people to get access to securities in fractional format, start to put away $5 a month, $15 a month, $20 a month, and you're rounding up your credit card. Like anything that allows you not to have to spend, $1,000 for an Amazon share or, however much like a Berkshire B share is, and like get that exposure in a more efficient and accountable fashion.
But Acorns did that without tokens.
I understand, but don't you think that it's, a better model to have it tokenized? It's more efficient, it's less cost effective. Listen, could be wrong here. Like, we could find workarounds at all points, but then on top of that, you have, I think FTX got something right where they were having, trading 24/7 on tokenized versions of stock portfolio. Like, why does it have to be 9 to 5? Like, I mean, my job sure as hell isn't 9 to 5.
Yeah.
Right. Yep. I think most people want to have exposure and liquidity, not have to pay aftermarket pricing and all of that. So I think there's a lot of different use cases here on why things can be tokenized to increase liquidity, to increase the ability to distribute, right? Think about even during the pandemic when, the government was issuing, checks to everyone to help them survive the pandemic, right? Wouldn't it be easier if you just had a wallet that they can just immediately drop in, USDC or some version of a CBDC tied to that and better accounting? It's probably a pretty poor system for anyone who was trying to have, any type of tax avoidance. But how much easier would, an accountant's job be if everything was on the blockchain and you just algorithmically load everything up, right? It's, there's obviously privacy concerns around there, which we have to work through. And there's some use cases for not being able to see everything. Sure, a lot of traders don't want everyone to understand exactly their trading strategy and exposure as well. But as you work through some of these things, right?
Well, I think that's one of the most exciting things about the blockchain. The fact that it is totally transparent, I think is pretty exciting, right? And the fact that like everyone talks about crypto being pseudo-anonymous, it is totally not anonymous whatsoever, right? The second you've KYC'd, you're done. Like, I think it's regulators' best friend, the fact that everything, like anything on Bitcoin or ETH or any of these other blockchains is totally trackable, right? The second you put money on Coinbase or Kraken or any of these other centralized exchanges, regulator can go out in 3 seconds figure out who you are, right? It's actually rather interesting. I think it's an unintentionally good feature of digital assets, depending on how you look at it.
So it's good in some cases, but not in others, right? Like, if you're actually having a trading strategy, you don't want anyone to know your trading strategy.
You also don't need to trade on chain. You can trade on an exchange.
Listen, you can, right? But then that opens up the whole issue of counterparty risk.
But you could also, if you're running a trading strategy, you can just run it on multiple different wallets, right? Like, you can, the best mixing service. Everyone talks about Bitcoin and ETH mixing services. The best mixing service ever is sending your money to a centralized exchange, right? You want to hide your assets, right? Somebody tags your wallet publicly, send it to Coinbase, pull it out from a different wallet address. Yes, a regulator can still track you, but no one's gonna be able to copy your trade, right? I think a lot of retail tries to focus on hey, what is this smart money or fund doing? But in reality, the only reason that you could see what that smart money or fund is doing is because that smart money or fund wants you to see what they're doing, right? If Jump wanted to obscure their trades, they could obscure their trades.
That's a fair point. So again, that solves one of the problems, right? There you go. Again, like you said, there's a lot of benefits here, and I think long run you'll start to see more of them as it gets more mainstream adoption. But there's obviously some issues existing. I think the biggest one today is around confidence and where to keep your digital assets, and then also the onboarding process for most of these are pretty horrible. So to get the mass adoption that crypto really wants, we need to make it look probably a lot more like Web 2 than the current Web 3 format.
And so what areas of crypto are you most excited for from a growth or later stage perspective?
So again, this is probably something that's been said more recently, although we've been thinking about for a long period of time, and we're looking for kind of real world use cases. Right. So in theory, payments should be something, cross-border payments should be something that is, a huge advantage to use crypto versus existing kind of Swift network or anything like that. We're still looking for those opportunities. And again, we typically invest a little bit later stage once companies have differentiated themselves, not just as, finding product market fit, but differentiating themselves from existing competitors. So a lot of the stuff that's happening right now, I think is probably a little bit too early for us, but anyone out there that's working on this stuff, they love to chat. And then other, on the UI UX aspect of it as well, onboarding, some of the KYC or, security aspect. I think there's a lot of stuff that's interesting over there too.
And how do you go about sourcing opportunities in crypto? Is it mostly from within network? And what does the deal flow look like over the last 6 months, and particularly the last month or two? Like, how much has it slowed?
I mean, how do I source besides calling you?
Besides for calling me and looking at all of our podcast guests.
Of course. Listen, end of the day, everything's about network, right? So it's my job to make myself as available as possible, but also let people know that I understand what's going on. Because the last thing you want is to have someone that is an investor that asks you questions and like, this makes no sense. Because you have to understand from an investor's perspective, like they still have LPs that they have to deal with. So when something like FTX happens, like if you didn't think that I had to be on calls constantly with all my portfolio companies to understand their exposure and what's going on and what's the real risk to their business and then relay that up chain, like you're blind. And that's the same for every investor, right? So you want to make sure that someone like me is not just asking you for information, but also being able to give you insights as well and give you a heads up or help you find solutions around certain problems that you may be facing. So understanding the landscape, right, is the key point, and then using that network to get in front of the right companies and make it so someone's willing to give you an introduction and not just like, oh, like behind the scenes, hey, talk to this guy, for me as a favor, but actually like ignore everything he's saying.
And so how does the FTX collapse and ensuing contagion, which I think we're still sorting out, impact how Mirae broadly views digital assets? It sounds like you still have conviction in the asset class, but presumably there are other decision makers at Mirae that have a say at the table. Given that you guys are a $700 billion asset manager, has this materially impacted what you're hearing from Korea and from executives there, or kind of across the board within the firm?
So listen, I'd be lying if I said it had zero impact, but at the same time, like Mirae is Korean based, right? So Luna also had an impact, right? And if you think about Luna is actually more damaging to crypto than FTX is, because FTX was just effectively straight fraud, right? As allocated by today's announcement when SBF got arrested and what he was actually, kind of charged with. So listen, obviously it's my job to do diligence and try to weed out fraudulent, operators and not invest in them. So I think, this is maybe.
But you haven't heard like a hey, stop crypto kind of.
No, listen, we're still committed to the space, but I think crypto, like anything else, is probably a broader wake up call to make sure we are doing the proper diligence, make sure that we are providing the proper governance, right? It wasn't just FTX. There are a bunch of companies out there who were able to get large sums of capital without really even having to form a board. And without a board, there's no oversight. Without any oversight, things like this can happen, right? So are you asking the right questions? And if you ask the right questions and they give you the right answers, and then it turns out they were just lying to you, like that's fraud. I think people look at, fraud and think, oh my God, it's more prevalent in crypto. Like it's happened throughout, history. And, SBF basically took 3 of the most prominent fraudulent cases that existed and wrapped them all into one. When you think about like Lehman, Madoff, and Enron. But if you think about, Bernie Madoff, like people were asking for audited financials. He was giving you audited financials. People didn't realize they were audited by his brother. And like, that's how he got away with it. Right. So at the end of the day, there's only so much we can do around the fraud aspect of things, but being on top of it, I think having longer relationships with founders is helpful, because if you ask, a question and then the numbers changed or the way that he answered the questions changed, then it'd be an insight to, okay, well, something's not kosher here. So this isn't a knock on crypto specifically. I think it's just venture investing in a market where kind of the power has shifted a little bit back towards the investor, where we have a little bit more time to dig into companies. It's not, hey, give me an answer in a week. Hey, I don't really have that much of a data room. Someone preempted me. Like, are you in? Are you out? Being disciplined is always important, but now it's even more so because you maybe had a little bit more of an excuse, that you ever really had an excuse. If, quote unquote, everyone's doing it, it's the wrong thing to say. It's not something I ever abide by, but you can kind of talk your way out of it in that scenario. In today's environment, it's very front and center that, you really have to ask them these questions, be a little more on top of the founder and understanding the business, understanding the risks. So hopefully, people are using that time wisely and not just saying, okay, well, if I drag out the same questions I'd ask in 2 weeks over 6 weeks, that means I spent more time with the company and I did my job. No, like there's a little bit deeper level of diligence that you're able to do in this environment, and hopefully that results in better partnerships and more trust between the founder and the investor, right? Because if you take money from someone that you don't have any respect for and you don't trust, it's just a check to you, right? More likely to be defrauded or fooled. If you're talking to someone for 6 weeks, 8 weeks, 3 months, 5 months, and then you start to get to the point where it's worth to have a relationship with. This is what this is. It's a relationship. I give you money, right? It's not like, here's money, I'll talk to you, when you exit, right? I want to be a resource. I want to have a relationship. So, it's all relationship building, and having more time to do that before, quote unquote, tying the knot with a check, I think is helpful, honestly, for both sides.
And so let's go speed around the last couple of minutes we have here.
Sure.
So first question, we talked about Mirae, but the venture fund has LPs that aren't Mirae. Is that correct? So what are you hearing from LPs outside of Mirae in terms of crypto exposure? Is there any concern that's been addressed to you guys? And broadly, from a fundraising perspective, how tight are allocators being right now? Not just in crypto, but kind of across the board. How much do you think fundraising for venture funds specifically has slowed from kind of its peak last year?
So again, this is more of a macro question. It's obviously a flight to quality.
Yep.
Right. But if you think about an allocator, right? Let's say I'm an allocator and I decided I want to give 20% to venture.
Yep.
Right. If my public book is down 50%, then my 20% allocation is down 50%.
Right.
So obviously it makes things more difficult. And the same thing for crypto, right? If my crypto allocation was 5%, even if I keep the same 5%, which you may not in the current risk environment, right? That's still down 50%, even before you figure out if you want to drop your crypto allocation from 5% to 2%.
Right.
So when you're thinking about where the capital is coming from, these capital allocators are thinking about it from like a macro perspective.
Right.
And there are cycles where you want to be more risk on. There are cycles where you want to be more risk off. We are in a more risk off situation. So if your total assets are down and the allocation to that riskier portion is down, it's obviously more difficult to go out and get capital.
And so, what do you think the recovery looks like for crypto? Tokens specifically. Do you think the market ever fully recovers? Like, do you think, obviously, from a venture investor perspective, right? I think kind of the broad swath view is 90% of startups fail. Do you think it's kind of the same thing I'm talking specifically on the token side?
Probably more than 90% that fail, if I had to guess.
I think the question also, and we don't need to answer that, but is like, what does failing as a token mean, right? Because these tokens will always exist in some capacity, right? There are tokens that exist where there's no company backing them anymore, right? So
I guess failure is zero liquidity and you can't get out of your position.
Right.
So I think that's probably an easier answer. If you're thinking about where things end up, you got to prove that you're providing value, right? If the token's not providing value and there's no reason for users to hold it, if there's no buyer on the other side, for any reason, then it's a worthless token. Like if you think about even during the financial crisis, there were assets that were still held on books worth millions, tens of millions, hundreds of millions of dollars. But if there's no buyer on the other side, even for $1, then that asset is actually worth zero. So it's not just a token issue; it's just an asset issue.
And so, what is your hottest take right now?
Hottest take
in crypto.
In crypto, my personal belief is I find it hard to believe that there's really any other layer ones besides ETH and Bitcoin that survive. Like I'm very bullish on the ETH plus layer 2 solution as opposed to multiple layer ones. Now, probably be proven wrong. I think if you looked at in 21, probably people thought maybe 5 to 7 of them really exist long run. I don't know. I've been asking for maybe 9, 10 months. Like, how many layer ones do you think exist in 5 years and 7 years? Interested on your take on that too. But including Bitcoin and ETH as layer ones, like how many do you think actually exist in 5 years?
Yeah, I think it's too early to tell. I think it's even too early to call. I think ETH and Bitcoin are clearly winners. But I think that there are other layer ones that are building or layer zeros that are building interesting technology for people to build like app specific chains on and other layer ones. So I think I couldn't tell you who the winners are besides for Bitcoin and ETH, but I think it's too early to call anybody else out of the competition. But if you had to say, confidently put your money in 2 assets in crypto, obviously it's very easy to make that determination.
It goes back to the flight to quality, right? So 2 things that will be around in the long term, but then again, do you know what those things would be valued at, right?
But also keep in mind, like ETH didn't exist, since before 2015, right? Like it's not even a 10-year-old technology.
What was the alternative to ETH at that point?
Well, there was really, it was like pure coin and name coin and green coin and stuff like that.
Well, that's the point I'm making. Like,
well, but those were very different assets, right? So there wasn't, but like I think, or building on top of Bitcoin, right? There was a lot of conversation. There was Omni on Bitcoin and things like that. But I think that right now, ETH certainly has most of the dev talent. It has most of the energy. It has most of the projects. But there's still such an incredibly small number of people actually using Ethereum in the broad scope of the world, right? Like it is so. If I had to guess, and I could be wrong, the number of active users on Ethereum that are not bots, if I had to guess, and we have the data on this, I would assume is less than 100,000 people, right? So you're talking a fraction of the world's population, right? And if there's another blockchain that comes out with this exciting real world use case and actual usage, like most of the things built on ETH are like speculative assets, right? Or things like that, or NFTs or whatever. I wouldn't count anything else out yet. I think it's a little bit too early.
I think that's fair, but then you have to look at me and say, where are the developers, right? Because how are you going to get all these developers to build on this new platform? So I believe... Well,
for example, Cosmos has seen a massive influx and increase in the number of developers. I think there's certainly other chains that have. I think the question becomes, not is the developers within the ecosystem, not just the chain specifically, but developers also move, right? Developers are going to look for the best products and the best opportunities, right? Facebook was the coolest place to work at 10 years ago. Is it still the coolest place to work at now? So
I agree with you. Everyone has their day, and it's probably too much to say there'll never be another.
I think your point is understood, though. Your point is taken, right? And I think it's a fair one. And so my final question, and you don't have to answer this. This is a very important question: is the Michigan TCU score? I'm not sure if this episode will come out before or after the game, but what do you think the score is?
38-24 Michigan.
All right, you heard it here first. And so, final question is: where can the listeners find you online and learn more about Mirae?
So, Mirae Asset, the U.S. venture team has their own website. Just Google Mirae Asset Ventures at your own discretion. Find me on LinkedIn. I'm not really a big Twitter user, although trying to be better. That's that.
Awesome. Well, this was awesome. Thanks for coming on. I learned a ton. I have a lot more questions, but we already went an hour, so thanks so much, and I would love to have you on again.
No, thanks for having me.